All right, traders, welcome to the webinar. We'll get started very shortly. Good to have you all here. Markets are a little bit of a mixed bag today. Nasdaq's getting hammered. Some of these chip stocks taking a bit of a beating. Crypto stocks rallying. We've got, gold trying to chug up very slow though, isn't it? But the trend is still its friend with gold. Russell bucking the trend up. So there's a mixed bag out there in China, which everyone seems to be watching for good reason because there's a lot of decent price action on that. Even if you don't trade it, I think it's a great story to watch. I think I'll talk about that more later in the webinar. Very briefly, there's a slide on it on the end. I think there's a lot of good information coming out of China in terms of price action and responding to how different people are reacting. And even if you don't trade the actual index, it's interesting. Some of those Chinese stocks are down on the Nasdaq. What's the FTSE been doing? I rarely watch the FTSE much, if I'm frank. DAX, fine. FTSE. I know some of you guys love the old FTSE. Can't prize you away from trading the FTSE. But yeah, I don't watch it very, very much. Okay, so let's get started, shall we? Welcome, ladies and gents. Okay. Good timing. Okay, so I'm going to talk for about 45 minutes or so, and I give you opportunity for questions and answers. I think you can all hear me okay. You'll be able to see my screen. Should all be fine. We're going to talk today about navigating breakout traps. So my objective today is to make you into a breakout ninja. No, it's not really. It's going to improve, hopefully, your breakout game a little bit. Breakouts, to me, sit in a certain bucket of strategies. So you've got a sort of different buckets of strategies that you look for in your whole trading plan, and breakouts to me sits in their own sort of section, if you like, because the game's changed quite a lot over the years. Over the couple of decades I've been trading, breakouts have changed massively. And if you kind of listen to interviews with traders who are trading, many years ago, 80s, or even before that, there was much cleaner moves. It was a much more different environment. Today, algos are running the show. There's these kind of stop hunting, if you like, liquidity grabs, if you want to call it that, where the market tends to trade the liquidity, stops people out. You get those wicks, you get those fakes. So we've got to adjust. And adapt. Now, breakouts can be super effective, but there's so many traps we can fall into. There's so many things we've got to watch out for. And I think, you and I have to be smarter about how we play these breakouts and how we position for these rather than taking the easy, seductive trade. I think there's a better way. So I'm going to share that with you today, share with you some ideas, some thoughts, and some perspectives on navigating breakouts a little bit better and the traps that come with that. So great quote here from Jesse Livermore, of course. Patterns repeat themselves. Patterns repeat because human nature hasn't changed for thousands of years. And I believe that to be true. And there's certain conditions where breakouts are super effective, and that comes a lot down to psychology, nature. We're going to talk about trap traders. We're going to talk about pre-positioning for breakouts, some of the stuff that don't think changes, but there are some changes that I think we need to adapt to in the modern market conditions, and I'll share those as well. So if you'd like to get yourself comfortable, get yourself pen and paper, any questions you've got, you can stick them in the Q&A. I'll try to address those at the end. First of all, I do need to remind you, ladies and gents, please, that we are talking about something that's a very risky instrument. If you're trading a spread bet product or a CFD product, as those products that Pepperstone offer, appreciate that they're a leveraged instrument. They come with the high chance of, or high risk that comes with trading those. There's a good chance that you can lose a lot of money. There's also the opportunity to make a lot of money. It's that game that we play as traders, and that's why we trade these instruments on margin, so that we amplify the gains when we're right, but that also has the downside of amplifying the gains when we're wrong. And our job as traders is obviously to tilt the scale in our favor, but do understand that there is a risk involved in that. You kind of have a free lunch here, so just be aware of that. And also, if you're brand new to trading, double check that you understand the product and instrument you're trading. Pepperstone's got demo accounts. You can just play around with it, get some virtual funds, and get used to the game, and get used to placing your orders, how much you're risking, stop losses, all the other stuff, risk management, before you even decide to get going with money that you can afford to lose. So I just want to say that, because I hate seeing people get into trading and don't understand the risk. If you understand the risks and you don't understand how we're going to play, then let's go. Okay, navigating breakout traps. Just a reminder very quickly. If you don't know me, my name's Mark Holstead. I've got a couple of decades of experience in the markets, but I don't have all the answers. Don't stand here saying, yes, this is exactly how to do it, and you should follow me and do that. Yes, I've been trading for a long period of time. Yes, the markets have been kind to me, but I'm here to kind of share with you things that I think are effective, now, things that I think you've got to watch out for. And running a trading community, traders mastermind, I also get to see other traders developing, coming from very, very struggling to a couple of consistency, a couple of green years. I get to see people make mistakes and kind of fall by the wayside and give up on the game. So I'm reasonably well placed to kind of look and observe and share my own experiences and things I see from others. And obviously, in contact with some superb great traders out there, and I kind of see how they progress as well. So I think I'm well placed to help you. And that's what I'm going to do this evening. Always do your analysis, your research, your homework. Never take anything you hear for gospel or the truth. Kind of look at it for yourself and do your own digging. And I believe you should do that anyway. Even if you kind of see something and it really resonates, it always has more of an impact and gets embedded into your strategy and your approach and your mindset when you dig it into it yourself. Okay, so do that. And of course, I always say things take time. If you're going to make some adjustments to your plan, to your strategy, to your way of thinking, to your mindset, I found the best way to do it is to plan the change, stick to that change for a certain period of time, and then review the results from that change before making course corrections. Too easy to be seduced by the short-term lack of impact or extra impact or outsized impact is probably the better word, and then go and putting more weight on it or less weight on it than it should have. Okay, so let's get rolling with that stuff. All being said, I think we're good to go. Okay, so what exactly is a breakout? Oh God, this is the most boring slide in the history of the slides. Let's just get it clear first, guys, because we need to know we're on the same page. So a breakout is, a break of a key level to a fresh high in the case of a bullish breakout, of a key level to a fresh low in case of a bearish breakout. There are multiple different definitions out there and multiple textbook ways of seeing it, but you and I both know what we're talking about here. We're talking about the market trading from kind of inside out to fresh territory, to fresh highs, to fresh ground, whatever fresh ground means to you, and we'll discuss that in a moment. We're talking about intraday, we're talking about multi-day, and same to the downside as well. So often I'm going to give examples to the bullish side. I think it's just easier to kind of reference in your mind, but most of the time they will apply to the opposite side. You just got to be a bit smarter sometimes about when you're changing from long to short. It's not always a mirror image, but we'll touch on that. We won't go into too much depth on that, but we'll touch on that. Okay, so let's just, that's the basic stuff, right? I think we all know that. We all understand, breakouts is the kind of thing you learn when you first start digging into trading. Ooh, a breakout. So we need to remember, what are we asking? And also we need to know what causes it and why does it have edge. So what I'm saying is here, so what are we asking? We're asking price to continue higher and higher and higher. Okay. And we also have to ask ourselves the question, what is causing this breakout? I think we can get too sucked into just trading lines on a chart. We're looking at the candlestick patterns. We're trying to decipher this when actually we're trading other people, right? Yes, okay. A lot of the time algorithms are running the show, but they've been programmed by the people. They have parameters that are set by the people's objectives. Is it to generate alpha in a fund? Is it to protect against risk if they're a market maker? There's all these different things that need to be considered. Now, we can't always take everything into account because that's the beauty of the market, right? It's an ever-changing puzzle. But often we can say, okay, what are we asking here from the breakout? What are our expectations when we buy this breakout? Why is it breaking out? Why would this opportunity have edge? I think that when we take a step back and look at it through that lens, it's a much more smarter place to be as a trader rather than, well, this candle's breaking above the high, so I must get long. I don't think that's going to serve you over time. I think that it's being a little bit cleverer about how you're thinking about this breakout opportunity strategy. Okay, so let me just check this. There we go. Okay, so some of the common traps. We've all been here, and it's nothing to be ashamed of. It's nothing to be embarrassed about. Listen, we all get seduced by the quick breakout trade. We've all been seduced by the quick breakout trade. It's like you're there in front of the screen, markets you're watching, just coming up to a level, you're like, oh, I'll just jump in here. It just rally a bit. I'll just take a few ticks out of that, take a bit of money, stick it in my account. It'll be 30 seconds worth of work where, you know what, market's got momentum. I'll take that quick. We've all done that and been seduced by that at some point. Now, many of us stick the hand in the fire, and burn it and go, you know what, I need to be smarter than this. It's not just as simple as seeing a break of a high and jumping on for quick momentum. Now, okay, the funny thing, the ironic thing is we know that very often you can do this and it works and you go, ooh, breakouts work, but actually we're going to talk about this. It's layering the context that precedes that. It's probably the reason why that breakout works rather than just that candle high break. So just being careful. Don't get seduced by seeing a so-called quick breakout trade, jumping on the trade and not really accepting the risk, not really understanding where the trade is going to go. There's so much more to it. It can be very powerful and very lucrative, or potentially very lucrative. We've just got to do a bit more homework to it. Okay, so not appreciating context. It's a big context element in breakouts. That's so important. We're going to cover that in detail. Forcing a breakout. Gosh, how many times have we done this? You know, you've seen a trade, you kind of go long, doesn't quite go. Stopped out. You go again, you get stopped out. You go again, you get stopped out. Now you're down 3R and you committed. You're like, oh, I've got to take it now. It's going because I've already lost 3R trying to get this. You go again, 4R. Maybe it finally goes and you've already down 4R. What's the trade going to give you? You might even end up breaking even if you're lucky or losing a little bit. So taking too many bites of the cherry on a breakout, that's a common trap. Maybe you fall into that. That's something that I definitely was a bit of a nemesis for me, kind of trying to force things too much rather than going, hey, what's the best play here? How can I position for this? What am I expecting? Why do I expect this to happen? What is the context behind this? And then structuring my trade kind of around that. So just being mindful that these, I think, are some of the common traps that we don't got to be careful we fall into. Someone just stuck their hand up. You want to put in the Q&A, I'll try and help you out at the end if I can. Okay, ask yourself this. These are good filtering questions, right? By the way, I thought I'd mention, it doesn't matter what time frame you're on. You can be on the 1 minute, you can be on the 1 hour, you can be on the daily, you can be trading currency pairs, you can be trading commodities, you can be trading orange juice for all I care, right? The questions are the same, the price is the same, it's supply demand imbalance, it's price action, it's the response to key levels, everything is similar. Now, I still believe that markets have their own little quirks, they have their own little dynamics, you know, the dynamics of, let's say, crude oil, which has, you know, a supply and demand imbalance. There are people consuming crude oil. There are people producing crude oil. There's also the geopolitical sensitivity of crude oil versus, say, a stock certificate, a stock in Microsoft. If you're trading the CFD of Microsoft, you're essentially trading the share price of Microsoft, right? That doesn't have the same supply demand dynamics. Now, not that matters too much. I don't want to get into the weeds and dig in too much, but you know, there's sometimes you have to really understand the product and instrument you're trading. So why would other market participants buy after me? You know, I'd be like, well, what sort of question's that, Mark? Doesn't make any sense. Well, just think about this. If you're buying for price to go higher, someone else, a lot of people, or one big player, or many big players, have to buy after you for price to go higher because offer has to be lifted, next level price, next level of price, next level of price, bids have to come up, price agreement has to go higher and higher and higher. So when you're buying an asset, when you're buying, you know, spread bet equivalent of DAX or whatever it might be, you have to ask yourself, listen, why are people going to buy after me? Why? You know, why have they not already bought? Where's the urgency there? Why is anyone going to suddenly buy and rip this thing through highs? Why does anyone care? And if you can't answer those questions, and I'm not saying you have to have a definite answer like, well, it's because of this, this, and this. You know, it's not necessarily going to be very detailed, but it might be like, well, I believe that there's, you know, a lot of shorts trapped after the prior hours price action, or I believe that, you know, the catalyst or the fundamental shift in the market's engine of, you know, interest rates or whatever it is, where the market trade is helping the tide, rising tide lifts all ships. We've been consolidating for multiple days. You know, if you build a story around it, then you often have a reason for the trade. And if you have a reason for the trade, number one, it helps you with confidence when you're pulling the trigger. And number two, it helps you with confidence with holding the trade. Right? If you think a lot of people care about this, you think there's a lot of time sensitivity. In other words, people just want to get in now. They're bidding, they're buying. They don't care what price, there's an urgency to it. Then it's easier for you to take the trade. It's easier for you to be positioned. And I say here we need perfect conditions in quotes because we're never going to get perfect conditions, right? You're never going to get something that's absolutely, well, maybe you do, and depends on what parameters you've got, right? But what we're trying to do is swing the odds in our favor rather than taking every little technical breakout that looks like a textbook perfect break. We need to, I believe, take into account some of the things that are more important. What's the daily trend doing? What's the market engine? What was price action prior? Can we kind of get a view of how price action is, how price action has been, and extrapolate that into current conditions and say, well, breakouts haven't really been working. So is my expectations too high? More on that in a moment, but just kind of wanted to plant those seeds now. Okay, so real breakouts occur. I've got some great chart examples for you in a moment as well. Real breakouts occur when there's supply-demand imbalance, there's a sense of urgency. And I've said this before, time versus price sensitivity. And let me explain what I mean by this. If somebody is, let's say they're buying, I don't know, 100,000 shares at $1, right? Just rough example, because let's not try and do complicated public maths here. 100,000 shares at $1, right? And they say, okay, I don't want to pay more than a dollar. And this could be any market, by the way. I don't want to pay more than a dollar. So price comes up, it's at 101. They say, no, I don't want it. I'm not paying more than a dollar. Price comes back down, it's sitting at 99. Maybe they pick up a few thousand shares, pops back up to 100, pick up a few thousand more, goes a little bit higher. They're not buying anymore. They maybe only bought 20,000 shares, they've got 80,000 left to do, but they want that $1 for the share. Price comes back down to 90. They're getting more aggressive. They're buying, but by 90s, 92s, 93s, 94s, 95s, and they fill the whole order. They're not paying more than a dollar because they're price sensitive, right? They think it's not worth me paying more than that. I must pay that. And of course, that's why when markets go below key levels, often they get stretched and pop straight back up because there's a sense of value there. Going off topic a little bit here, but that's kind of one of the things when you're price sensitive, right? It's a limit order effectively, but we know that traders who are working large clips won't just have a limit and stack it there. They'll work the order. Sometimes they use algos, etc. Now, if you're time sensitive, you've got a sense of urgency and you're basically saying, hey, get me in now. So that trader who had 100,000 to buy a dollar might say, I've got 100,000 to buy. I don't care what I pay. I need it done now within 5 minutes or 1 minute or an hour or whatever size position someone's trying to work. Could be multiple days, right? Short squeeze is a perfect example of that. And the difference is that someone will pay 101, 102, 103, 104. They're like, I need in now. It's basically a market order. It might not be just a market order. It might be a bit more nuanced than that when we're talking with big order sizes and hedge funds unwinding positions, etc. It's going to be much more than someone just going bang with a market order. That's a fat finger. But if there's a time sensitivity, it's like I need in now. I think this is a great opportunity, or I'm trapped. I need out now. I need to get out now. I need to cap the loss. There's various different motivations for larger institutions and traders, and people are moving the markets to take trades and make deals. We don't know that for certain, but we're trying to find it when we have that sense of urgency, when the other participants are time sensitive, not price sensitive. Price sensitive results in range bound conditions. Sellers are sitting at highs, buyers are sitting at lows. It's flopping and chopping around in between. Maybe it has a little dip below. Maybe there's a little flurry of action, but there's no real urgency, right? No one really cares. Versus time sensitive, market's ripping and it's getting now or needs to get out now, whatever the case may be. They don't care what price, they just need to get in or out, depending on what we're doing. So that you can see, hopefully now you can kind of think, okay, well, I understand that the motivations are different, and that's going to show up in the chart in a very different way. And that's when we really want to get involved in breakouts, when we can sense this. Now, I'm not here to say we can automatically do this, but we can look for clues, which I'm going to share in a moment, clues that people are more time sensitive, and we can stack the opportunities in our edge, or the chances of success in our edge, or stack these layers of edge in our favor, so that we can try to only be positioning when we believe the other participants have time sensitivity. They need to move now, which is going to cause that breakout. They don't care if it's 100 or 110, they need in, they need to buy. And that's what we're looking for. You can see there's a lot of difference between that and someone who's just bidding it, coming back, bidding it, coming back, often when we get the fake outs. And number three, the final thing is there's room for price to run. And so the big thing here is to not try to force your will or your requirements for your trade onto the market. If the market's been doing a typical daily range of 200 points, let's say, I don't think an instrument doing 200, but 200 points range, right? And you're an intraday trader, and the market's in pretty reasonable, normal conditions. There's no reprice scenarios, no headline, and you just see a kind of intraday breakout. The market's not really been trending aggressively. It's not excessive volume. There's none of these markers that may indicate a difference in shift in sentiment or a shift in structure. And you're then buying when you've already done kind of 180 points range, expecting another 100 points. You're probably asking too much, right? You're probably not calibrating conditions, and there's more on that in a moment, but often thinking, okay, where am I trading this? Are my expectations in line with what the market is doing? And does price have room to run if I'm going to trade this break? Okay, so what creates urgency? Pretty obvious stuff. Catalysts like news, economic data. We've all watched FOMC. We've all watched interest rate announcements. We've watched CPI. We've all watched stock earnings, that type of thing. That changes and what I call potentially reprices the market. If the interest rates suddenly change massively and it's outside of expectations, all of a sudden the expected value of the underlying assets, in this case, the basket of stocks, becomes more or less depending on what's happened. Okay, interest rates have been cut aggressively. And I know it's not always as clear cut as that, but if we're just using a simple example for now, they might say, okay, well, that's super bullish for the market. And so all of a sudden stocks get repriced a lot higher because the company value expectation is much higher. I know there's some more complexity with that, and it's because of recession, blah, blah. So it's not always clear cut, but a clear cut one might be if you're trading an individual stock, right? An individual stock comes out and it says, hey, a great one will be, I don't know, they've had a court case and they were kind of allocated a massive amount of money to pay this fine or whatever it is. I'm thinking on the fly here, but that all of a sudden is thrown out. Then the value of that company automatically would be perceived as being higher. It's a reprice event because it's a binary. Hey, this company is now worth a lot more, or we've restructured our loan and we no longer have to pay these heavy interest payments, or we've won a massive contract that's worth X per quarter over a life cycle of 10 years, whatever it might be. Those sort of things are a reprice event, and it's a catalyst. So economic data, if you're looking at broad markets, individual news on stocks or news, often we get stuff that's impacting the price of oil, catalysts, the Middle East conflict, etc., etc. You know this. Okay. Trap traders. So bull traps, bear traps, prices kind of pushed below a low. People have so-called shorted into the hole, and now we're rallying hard. We know there's potential of shorts who are caught in that who are going to have to cover. Now, this is a little bit up for debate, and there's a bit of discretion and a bit of judgment and assessment here from your part. You've got to look at the chart and say, are traders trapped? There's some obvious traps that you can spot. We'll chart example, I think, on the next slide, but that creates urgency. When a lot of people have been trapped short, market's been hammering through prior lows, all of a sudden there's a V-shaped reversal, rips to highs. Those guys are trapped. They need out. So that adds fuel to the fire. So that's going to create more urgency for the price, and more urgency for the price is going to help the breakout potentially work more and be more aggressive. Number 3, a ticking clock. So a ticking clock is something I define as there's a definite time limit on this. And a really simple everyday example is the closing bell. If institutions are trading stocks, then yes, there is post-market action. Yes, there is pre-market action on some of the shares, but the options close at a specific time. The volume, liquidity is there. The liquidity is way less. So we're going to define as the opening bell, as the closing bell. If there's a sense of urgency, we have got 15 minutes left to get this order done. What happens? Everyone's working to that clock. Then they become really, really time sensitive and not price sensitive. And we often see that amplified on heavy down days, heavy up days, that type of thing, especially heavy down days, actually, when the market's just hammering through the floor. People know I've got 15 minutes to get it done. What do you think happens? Again, we're trading people. They're sitting in office. The phone's ringing. The client's saying, have you sold that stock yet? I want to get out. You've got another order being worked, this and that, the other. What are they doing? They don't care what price. I get out. And so with 15 minutes to go, all of a sudden the ticking clock creates that urgency as opposed to, well, I don't care, just work it over the rest of the week. Now, this doesn't always come into play, but this can do, right? So just be aware if there's a ticking clock, something that everyone's watching. And that could be end of the quarter as well. Often end of the quarter, we have, hey, 15 minutes till the end of the quarter. We need to get this order done. We don't care. And that's often why you see price oscillating around. And a wider sentiment shift. So something big happens that shifts the sentiment of that market one way or the other. You could have example like, this is a real hypothetical example, but imagine if you're trading crypto, okay, and then all of a sudden, a lot of the Western countries came out and said, we're banning crypto, or we're banning this, or something shifts massive. I don't expect this to happen, but you get the idea. Something that shifts the sentiment of that massively, all of a sudden, that may create, hey, the whole participants watching this, observing this, are now going to have to do something very, very differently, or how going to perceive this very differently. China was a perfect example. Recently, China came out with a lot of bullish comments, and that created a massive sentiment shift of, hey, we're super bullish on China. China started to rally aggressively. A lot of people jumped on it. Hedge funds were positioning, etc. Doesn't mean it's going to play out forever, but there was a sentiment shift there. Okay, so trap traders example, here you go. Just some recent examples here on trap traders. These aren't maybe the most perfect sweet spots, cherry-picked examples, but I like to use more recent examples and say, okay, listen, this is sort of stuff that has happened. This is kind of what we're looking at. So trap traders here might be, okay, we've had the market drifting off overnight. It's tried to rally. The opening print was here. Everyone's kind of bought this open. All these guys now, when we push back through this low, they're trapped. They're trapped. So it's not the biggest trap in the world. I'm not going to say this is the perfect textbook trap, but you can see a lot of people who've been buying in this time period here are all now caught. They're all underwater when it goes below here. And this is kind of potentially helps this cascade effect. So another example here might be on the yen, a little dip below. A few people got trapped in there. And then when we kind of pushed up to the high side the next day, these guys, where's their stop going to be? Probably above that high. The very worst case scenario, unless they're longer term plays. Of course, we never know, but that may add a fuel to the fire. This kind of often dip below and push back up, or even if it stays under for a reasonable period of time and then reverses quite hard, that's often going to trap traders. Okay, reprice scenario. China, great example, came out with all sorts of good news. Not going to go into it, but all sorts of bullish news that changed the fundamental perception of what the Chinese index was worth, Chinese stocks were worth. That's a reprice scenario. The market has been repriced, and it's just aggressive buying, right? So you've got a big day of buying, consolidation, second day, etc. So, oh, final thing, ticking clock. So this was a great example, actually. I did have to go back a bit on this one because I wanted to combine some of the examples. You've got trap traders here. So big, heavy down move at the beginning. This is the S&P 500 ETF. Big, heavy down move here. Lots of people selling into this low, shorting the whole, rip straight back up. Where's their stop going to be? Probably above there. And you've got the ticking clock of the bell going there. So you get that final flurry into the close. So combining these things, so this would be a much better, so in my eyes, breakout opportunity trading this breakout here on the S&P 500 than say, something in the middle of no man's land here. I've got some examples in a moment, but you can see the point because you've got some trap traders adding fuel to the fire. You've got a ticking clock knowing, hey, actually, there's only a certain window of time here. Not only we've got people trapped, there's a multi-day high. It's a change in sentiment. Something's happened here. People are much more sensitive to time than price. That even though maybe if you isolated those 5 candles, it would be the same 5 candles as anywhere else in the chart, the fundamental stuff that's underlying it and the tide that's helping support this is much, much different. So we'll have a checklist in a moment, don't worry, of towards the end of kind of all the things that matter and go into a little bit more detail, but I just want to outline that type of stuff. Okay, so here's a good checklist to help you not get caught in fake outs, not kind of get sucked into stuff without being really clear this breakout is going to work. In a moment, I'm going to talk about how to pre-position. I believe this is a really good, powerful way of doing it. But first of all, let's just think of the things that we want to see for a breakout. So I always want to see the higher time frame. Even if I'm trading the short time frame, what's the higher time frame doing? If the higher time frame is in a super bullish trend, then I'm just not going to take breakouts to the downside. And I know people are like, well, it could go to low. I'm just not going to do it. I've learned over time that I don't want to fight that bigger trend, and there's more than enough opportunity to not be. Imagine this, right? Price has been going up and up and up. I'm not saying it at exhaustion mode, that's slightly different. But if price has been chugging up, and there's just a nice steady trend there, good fundamental kind of push to the upside, everything's chugging, and then you get a kind of down day that's a nothing down day. It's not a big response to anything. It's not a catalyst, and it comes down. It kind of forms a low, pushes back up, comes down, about to break the low. There's no way in a million years I'm going to take the short side breakout there because the higher time frames to the upside. It just doesn't make any sense. I'm going to wait and possibly take a breakout to the high side, but I'm definitely not going to take a short breakout. So thinking clearly about what the higher time frame is doing, and you might be like, there's a objection there of, but Mark, I'm going to miss a load of opportunities if I do that. I would rather you just strip out 50% of the opportunities and focus on getting the one and say, hey, I only trade this long at the moment because the higher time frame is up. Now that means I'm buying flushes. This is not a topic of the webinar. I'm buying breakouts. I'm trading afternoon push. There's still things you can do, but you just add the odds and put the odds on your side. Now, it doesn't say you don't ever trade that from the short side, but I think sometimes when the higher time frame is telling you, screaming, I'm in a big uptrend, then why fight it? Why fight it? Okay, so where are we within the daily range? So weekly range, daily range, whatever range you're trading. If you're in the middle of it, nobody cares. If you're buying a breakout in the middle of a range, just know you don't have a positive expectancy. You probably have a negative expectancy because you know that very often the market will break out. Where's it going to run to? Very difficult to structure the trade. You can't have any confidence in the trade. So think about that versus, hey, I'm at the very, very high of the range. We're breaking out of a 4-day range. We're breaking out of a 52-week range, whatever it might be. That's much more exciting to other participants than it is just sitting in the middle of a multi-day range. Intraday traders, intraday boys and girls out there, what's the time of day? Super, super important. This is a whole nother topic that, maybe we could dig into at some point in some depth, but there is a world apart taking a breakout at midday versus afternoon, kind of with a ticking clock, with a catalyst, or the opening range breakout after a gap, after some data versus a midday chop breakout. Worlds apart. And again, I want to kind of, it's really what I'm trying to say here is thinking a little bit more than just those candles. Yeah, everyone talks about the candles and this and that and the other, and fine. The nuance of the candles are okay, but that everyone knows what a breakout is. It's a break above a high, a break above a low. There's nothing more to learn. Now it's like stepping back and saying, okay, well, what's going to help this breakout? What's going to give some support to this breakout to work? What's the market's engine? So, what's really driving sentiment at the moment? Is it news? Is it inflation? Is it the Chinese news? Is it Donald Trump's comments on crypto and his likelihood to win, for example? And we're going to kind of do a much more in-depth, reminds me, we're going to do a much more in-depth webinar talking about some of the ideas and ways to trade the US election in a couple of weeks. So make sure you're registered for that. My mind was just going off a tangent there, but what's the market's engine? Different markets have different engines. What's the existing range versus the average daily range? Just simple things like this. Hey, the average range we've done normally is 100 points. We've already done 90 at the moment. Market's not done anything exciting. We're not at top of range, not in a breakout condition, not had a reprice scenario. Well, I'm going to take a breakout. What am I asking for here? What's the market's prior behavior? And I think the next slide will show you a good visual for this. And what I kind of mean by that is exactly this. Let the market tell you how it behaves, right? Now, this is something that as a discretionary trader, as a screen-based trader, which I think you are, you can see the market's behavior. It can't hide it. It's there. It's clear to see in the chart. But many of us, and I hold my hands up, have been here, done that, ignore it. We ignore what the market's been telling us. And what I mean by this is we force our will to say, hey, the market's been kind of oscillating. Breakouts haven't been going too far. They've been pulling back a little bit. I'm going to take a breakout. I expect it to blow up. Well, the market hasn't been doing that. So why would you expect it to be any different now? Sure, sometimes volatility contracts and expands. And if that's a particular play you're taking, that's very different. But just review the prior price action and ask yourself, have the breakouts worked? How was the market's response to breakouts? Example here from S&P 500. Again, I've just used the ETF because the regular trading hours are easy to compact and show you in a chart. But you could be trading the CFD, the Pepperstone CFD. You look at this. Like, this is not breakout territory. Breakouts have just not worked. You buy them here. Okay, unless you're a very, very short-term scalper, there's not much room to run. They've run a bit. They've come back. There's been so many fake outs, little tiny blips here, pulled back, gone to high, faked out, gone to highs, faked out, Oh, we got a little bit here. $3 moves, $3.50. And this is a really big topic, but what I want to show you here is if you're looking at this saying, oh, I'm going to trade this breakout here. Well, everything's against you. The time of day is no good. You've already had the type of move from here to here, which is the same as the type of moves you've had before. The symmetry is about right. You're in the middle of a 3-day range. Market has not been breaking out and pushing too much to the high side. That's very, very different from trading Something that might be the opposite way round, that you've got fresh highs, you're at multi-day highs, you haven't yet moved the ADR of the day or the expected range of the day. The market's shown you that it's broken out and actually is running strong. So there's that the participants at the moment are keen to pay higher prices. So sometimes just looking and eyeballing the chart you're trading and saying, am I asking something that's completely different to the nature of the market? And you can't really, it's very difficult to put this down into a rule-based structure, but it's just visual stuff. And you as a discretionary trader, you as a kind of trader that uses the judgment to make these decisions, can look at the market and go, I'm probably asking too much here. I need to wait for conditions to change, or I need to adjust how I trade the breakouts. We'll talk about this in a moment. This slide. What is pre-positioning? So one way you can do this is to say, okay, all right. So perfect environment would be, we have all the ducks in a row. We have some fuels to the fire. We have traders trap. It's like that spy chart, right? That spy chart that I did, not this spy chart, this spy chart, S&P 500. This is a nice condition, okay? And assuming the uptrend, I know we've got an uptrend, but let's assume you didn't know there was an uptrend on the daily chart. You've got this, you've got a bunch of trap traders, break out a multi-day high, you've got a ticking clock, maybe there's a catalyst there. You see that's much different, right? And the market is behaving in a much better manner. Okay, so versus chopping around doing absolutely nothing. Even the candle is a different shape, right? Okay, so if you didn't have that, how can you kind of still trade the breakouts? So I think looking at it from a different lens and playing a game of chess with the market and saying, okay, so I'm going to consider what I call pre-positioning. And pre-positioning is getting positioned before the breakout. Now, you might say, well, this sounds like some sort of dreamland. I haven't got a crystal ball. How position before the breakout? Oh, well, yeah. Well, if I knew a breakout was going to happen, I'd go full margin. I'd hold it. And we're trying to be smart than that. And I get it. Sometimes you like some of these concepts, you think, well, and we're never going to get this right all the time, right? I'm not sitting here and saying this is how we do always. We can second guess a breakout and use our crystal ball. And no. But very often as traders, we can see a breakout potentially happening before it happens. We don't have to wait right until that last moment where price is going to break the high or break the low before we take our clip. We don't have to do that. Now, a textbook might say to do that, and maybe you do want to do that, right? If all the ducks in a row are lining up in a row and you're saying, hey, that the act of the price going to fresh highs is going to add more fuel to the fire for the trap traders. You can see how that would work, right? Because they're probably going to have stops there. Fine, you may well want to trade that. But sometimes you want to pre-position and think 3 or 4 steps ahead and say, okay, market is down at lows now. Right. So could the market break out today? And you say to yourself, well, actually, it could. If we kind of got a bit of a rally going, the average daily range of the day would take us to fresh highs. That might then encourage extra participants in going back to the first slide, who's going to buy. That because of this, and you start adding up all this and that and the other and say, okay, well, actually, do you know what? My thesis is to position early and hold so I have a cushion as we come into the breakout. So you're playing this game of chess. Now, of course, you're managing risk. Of course, you're using a stop. Of course, lots of things have to line up to get that happen. But you can now put yourself in a position of power. Rather than taking the breakout and being very vulnerable, because if you take a breakout, your risk has got to be in a certain place. You've got to sit through kind of pullbacks, through chop, through false breakouts. It's very tough sometimes unless you have all those ducks in a row to take the break. Whereas if you're pre-positioned and you say, hey, I'm taking this because of this trigger. However, if we get a bid that comes up, I'm going to be ready and holding this with a nice cushion before the break happens. And that means if the break happens and there's a false breakout, you're calm. If it does a false breakout, sits there, pulls back, sits there for 15, 20 minutes, if we're talking intraday, you're not too bothered. Versus you bought that break, you're sitting there watching your P&L, negative, positive, negative, positive, negative, stops you out. It's that multiple bites of the cherry. You can get rid of all that by thinking about pre-positioning. The fake out doesn't stress you out, because you're like, hey, it's a nice bonus. I'm already positioned from lows or from a structural trade that's down on the bottom third or quadrant of the intraday range. I've now sat through this. I've got a cushion. My stop is here. I've locked in a profit no matter what happens. If it fakes out and comes back, fine. If it breaks, then great. Then there's a massive amount of extra juice in the trade. And you can then be a little bit more strategic about how you're managing the trade as well, because you can start to scale stuff out into those impulsive pulses. So rather than being part of that buying, that's prices coming up to highs, you're buying, you can be, hey, there's a bunch of guys trapped down here and I've already positioned. As it breaks and we get that kind of extension candles, those urgency candles, I'll peel some off, sell into it, sell into it, sell into it, sell into it. And now you're in a beautiful position because you've got a core that you've held from before the breakout started to occur. You've offloaded some, you've cash flowed the trade as it's broken through highs. You're in a position of control because many of the things for traders is, it's the mental game. We know it's the mental game, and sometimes you have to put yourself in a position where you feel powerful in the trade, you feel confident in the trade, you feel like, hey, I'm now got a decent footing and nothing this trade can do, this market can do, can harm me. And this might be how to position for that, or how to get yourself into that state of mind, is that you think a little bit, a few moves ahead on the chessboard, and say, well, if I can position earlier, if I can get maybe on that flush, or I can kind of buy that first momentum bar in the lower half of the price, and I can hold it a little bit longer, then market breaks out. That's great. That's extra juice. Thank you very much. I'll take it. If it doesn't, then so what? And it just puts you in a much, much better frame of mind than actually risking capital on that breakout that could fake out. It could go. It's just, I think it's a much better place to be. And if you can put ourselves in a position of control with trading, then it becomes easier to execute the plan. It becomes easier to scale up the operation. It becomes easier to do the tough stuff like adding to trades. It just becomes easier. And often it's, the game of trading isn't always about maximizing the technicals. It's about, yes, that's important. Of course it is. The filters, the triggers, all that stuff that we use to take the trades is absolutely important. But often it's about doing the thing that puts you in a state of confidence. And I don't say comfort because trading's never that comfortable, but there's often thinking like that. How can I put myself in a place where I feel comfortable holding the trade? I feel confident holding the trade. And this is one of the tactics to do that, the pre-positioning. So how do we pre-position? We're not reacting to price. We're playing chess. Like I say, where could price go? Is the breakout possible? We're not second guessing here. We're just thinking several moves ahead, right? So example might be on gold recently. Okay, so gold recently, we all know daily chart's been chugging up, uptrend fine. But the breakouts have not been that aggressive, right? If you look at them during the regular trading hour session, that's been a fake out. That's kind of broken out a little bit. Here you got a little bit of a bid. Oops, didn't mean to press that. Got a little bit of a bid. You kind of broke out. Not really. It's only since this bit here where you really got going. Actually, if you bought this breakout here, you'd have been faked out. You'd have been stopped out. You would more than likely have had a stop there. Now, appreciate I'm showing you this hypothetical scenario as a way of illustrating what I'm trying to say with the pre-positioning. But let's say you believe in the uptrend in gold. You think it's going to push to highs, and the textbook would say, well, I'll just buy new highs. If it's going up, I'll just buy new highs. But you and I both know that if you bought an intraday new high here, you're probably not going to sit through all this pullback here. You're going to be stopped. And so when your thesis is correct, gold's moving higher, in which this case it has over this 2-day period, it has. But if you're timing the trade and trying to buy the breakouts and following the textbooks, you're just getting nailed and nailed and nailed. And there's nothing more frustrating than being right on the idea and looking at your P&L and blotter and going, well, why am I red? Why am I down? And that's often because the price action is telling you something different. And so in this example here, you look and go, hey, how can I pre-position? If I believe that price is going to push to highs, I want to be in a position of power and already be long as it comes to the break. So I don't care if it goes now or if it goes 10 minutes later or if it sits there and chops about because I'm already positioned. I've already played the game of chess. Example might be, okay, you're buying a VWAP. It might be that you're buying when some traders are trapped on, not necessarily a massive trap here, but it's done a little bit of a fake out below the lows here, and then it's pushed back up. Maybe you're buying here. So now you're in a position of power. And you're like, that's a different trademark. I get that, but you're leveraging it into two and folding them together and saying, this is really a breakout. I'm looking for the breakout, but actually I'm going to position beforehand. I'm going to think a few steps ahead and say, okay, maybe I can buy the dip and hold that through some noise for being then in a nice position, a very comfortable position where I have a cushion, I have some nice unrealized P&L, and I'm not so concerned what happens. Example would be, let's say you bought this fake out here. You kind of saw it do this, chopping around. You still think it's bullish. You still think you're going to hold the highs over multiple days. And rather than buying the break, which you're probably going to get stopped out unless you use a really wide stop, but if you use a really wide stop, the structure of the trade messes up, the risk order ratio just is screwed. But now you're kind of buying down here. You're thinking a little bit more carefully. And I understand, by the way, there's lots more nuance here. There's more subtleties of how to time this, how to position for this, and maybe it's a separate topic. But if you're thinking like this, I'm sure you can come up with a way of kind of looking to buy at lows or looking to buy on pullbacks or these double bottoms or fake outs or this type of stuff, VWAP kisses, and then say, right, well, I'm now ready for the break. And now if you're here with this, you're not too bothered by this. Now, this example might be a little bit, like, oh, it's a bit frustrating, but you still don't care like you would do if you bought this candle. You bought that candle on the close here. You're straight away lost. If you bought here and you're kind of, okay, well, let it do what it needs to do. I've got my stop at break even. Fine. I'm holding this for multiple days. I still think we're bullish. I just don't think we've got that much momentum and that much aggression. And you'd be right, because you can sit there and you can sit through all this. And if you're comfortable enough, then the trade actually works out. It's a difference between the trade working and not working. Okay, so clues to look for here. Is the breakout feasible? As in, the structure of the price, how much range have you done? How's the price behavior before is very important. Is the context of why people are going to buy solid? Is there a reason for it rather than just the pretty lines on a chart? And also thinking about how you're going to identify targets. So a good thing is to decide before the trade how you want to manage it. Are you going to just hold it no matter what? So in that gold example, like I'm holding this, it's top of the break even, I'm holding this for a multiple period of time. And a set period of time, I think, is a very good way of trading breakouts. Am I holding it to the end of the day? Do you want to hold it for a couple of days, a couple of hours, whatever it is? Because price takes time to do its thing. I know we perfectly would love price just to go straight up to our target or straight up immediately, but it takes time. So sometimes you might say to yourself, hey, I'm going to hold this trade. I've got to stop in. I'm going to hold it for 15 minutes, an hour, till the end of the day. Will you add to the breakout? Are you going to scale out of the breakout as it goes your way? Do you have a fixed target, like a whole number, like a key support level, a fib extension? And by the way, what you can also do is if you are, trading this type of environment here, I'm going to example in a moment with the China index, but you can pre-position, you can use the breakouts to your advantage rather than then you either see, I'm holding this price, I'm just trying to get the best price I possibly can to hold through the break, or you can peel out some and take some of the risk off. As everyone's scrambling to buy the break, you can be selling into them saying, I'll take half off on there, and I'm in a very, very powerful position. But the key is to really think about how you're going to manage the trade, because breakouts can be very emotive, right? You take it, see a burst of volatility, and if you're watching too closely, you see it pull back, you get nervous, you take the trade out, and it's a great trade. You just have to be a little bit more patient. But if you do a lot of the legwork beforehand, a lot of the thinking, a lot of the cognitive load of how you're going to manage it, then it takes the pressure off you. So example here would be the China index. By the way, I really urge you to watch what's going on here, even if you don't trade it, and Pepperstone do offer it. But even if you don't trade it, there is so much going on here that it's so much to learn. Like, we can just go back and look and see what's happened, what China's said, the massive amount of retail traders who are in it, the massive amount of retail traders who are using this advantage to get out because they've been in from years ago. There's so many dynamics going on. It's a beautiful, beautiful insight into supply-demand imbalance. And then technically intraday, just seeing these fake outs, seeing how the market's trading. As I say, it's an unusual hours, the regular trading hours of early hours of the morning, so fine. But just allocating some time to studying this, I think, is such a really, really, really advantageous to you as a trader who kind of likes this type of stuff. But example might be, okay, let's say there's a bunch of trap traders here. Does that create fuel to the fire to the downside? Yes, it might. So could you take this breakout? Maybe you could, because there's a lot of trap traders. The Chinese thing hasn't, I'm not going to go into this massive depth, but the fundamentals haven't been as positive as people have expected so far. There's a bit of disappointment. A lot of people, retail traders trapped, blah, blah, blah. That narrative might create a pressure to the downside. You've also got a bunch of traders who are maybe trapped here. So could you feasibly have taken this breakout? Yes, you could. I think that would be very reasonable of you. Now, talking about targets, what might you target? Well, you might target level to level. You might say, hey, I'm going to take the break from this level and I expect it to come to this level, which is fine. And you mirror that and you work out where it is and you structure it that way. You might say, I'm going to hold it until the end of the day. You might say, I'm going to put a stop at break even. You can structure it how you want. Okay, but it's just being prepared for that before the actual trading event. And then you had another kind of ticking clock type thing here, which was little fake outs, the upside, resistance tries to push above, and then all those people who bought there are ultimately trapped in this as it breaks through lows. And so the final breakout really just cascade down and down and down. So just thinking about all the different things and nuances that really come into this market. By the way, I did not trade this today. One of the few days actually I've not traded the Chinese index. But this is just really interesting to look at the moment. Okay, so final rules of thumb. Catalyst-driven markets can disregard key levels. If you go back and look at stuff that has news, forget your key levels. It's just going to rip. It's going to rip, pause, rip. What's the trend status? Looking at your higher time frame, you're using weeklies, your dailies. That is telling you what the sentiment is on the market, and aligning with that, I think, is so important. What's the market story? What's driving things? And setting your expectations. Extended targets. They can be hit, but you might have to sit through some retracements, right? It's not going to go straight to your objective. How are you going to feel about that? Do you want to be pre-positioned? If you're buying a breakout here, many of you guys know Peter, right? So Peter helps me in Traders Mastermind. Helped me. He's a very, he's a key trader in there. He's helping a lot of traders. He's been trading more decades than me, and he knows that actually, he'll never buy a break. He has to wait for that to come back in a certain pattern, and then he'll buy it, and then he'll look for that continuation, right? So it's expectations. Like he doesn't expect to buy this break and it sit through and go perfectly. He knows that the market has to unwind a little bit and then get that second leg that's going to force that price higher. So extended targets, they can be hit, but you're going to have to look at the market and say, what am I expecting? So good filters to operate is who cares? That's such a great filter. Come in and say, who cares about this chart? Does anyone care? If no one cares, no one's going to buy after you've bought, because that's the only way price is going to go up. Someone has to buy it after you've bought, and there has to be that supply-demand imbalance into the demand side rather than the supply side. If that doesn't happen, then the market will not go higher. That's pretty much it, and we lose sight of that. We're all guilty of that. So just asking yourself the question: who cares? Who has time sensitivity? Who needs in now or needs out now? What does the higher time frame context look like? What has price done previously? So if it's just been chopping around doing absolutely nothing, why would you expect it to be any different now? Where's the current price position relative to prior day's range, the weekly range, the multi-day range? All this stuff is very important, and it plays a key role into how impactful the breakout is going to be, or if you're just going to get slaughtered with another fake out. And does time and day play a role? If you're at the beginning of the early morning, say, opening range breakout type thing, fine. Midday, mid-range, it's just not going to happen. You're asking so much. So, all this stuff is so important to appreciate context and to really appreciate, the power of the breakout. And it's up to you to decide for the market that you trade in the time frame you trade, what's important. You don't have to have a massive laundry list of stuff that all has to be perfect. But you might say, actually, you know what? The market I'm trading, it's very bullish at the moment. So fine, I'm only going to trade breakouts the upside. But very often, if I look at the chart and I'm honest, my 15-hour chart, my 4-hour chart, whatever it is, they're not really going that much when they do go. Okay, so how can I solve Forex? In other words, I want to get long, I want to be long. Breakouts don't necessarily work the way I want them to. So can I pre-position? Okay, if I can, then what do I see on the downside that sometimes indicates the market might be turning higher? Is it a flush? Is it a double probe? Is it whatever it is? And that's your job as a trader, to be smarter than the average trader out there and think ahead of the pack and go, well, yeah, I do see how that can potentially work. Let me get on that trade, and now I'm being positioned for the breakout and be in a very comfortable position. Okay, so final summary, guys, and any questions, you're very welcome to put them in the Q&A. I'll help you if I can. Breakouts change a lot. Fake outs are common. Doesn't mean the market won't actually go, but very often it'll flush, come back. We've been caught in that many times before. So consider pre-positioning. I think it's something really worth looking into, and you're getting yourself in a position of power, because trading is very much a mental game. And if you're in a position of power, you don't care if it's going to break or not. You don't have so much weight on it. doesn't feel so much, there's not much emotion attached to it. It's not going to put you on tilt. It's not going to frustrate you. You're going to get pinged out, pinged out, pinged out, pinged out, then be pot committed, all that other stuff. That can go away if you can pre-position for the break. Now, is it always going to work? Obviously not, but it's a way of putting yourself in a nice, better position to trade. Forcing a breakout is a road to ruin. And honestly, the answer, the big thing is, who cares, right? Does anyone care? And taking a step back and looking at the bigger picture and looking at everything often is a very good way of deciding whether that breakout has a good potential to work or not. And you're a trader who's making his own judgment or her own judgment to make the decisions, right? So, getting so myopic on the individual candlesticks won't serve you. Stepping back and saying, hey, the bigger time frame money is driving this market. Institutional money is driving this market. They're looking for alpha. They're looking to make money from this. So do they care that this is breaking on this time frame? No. So why would I expect supply demand to shift so much that people are going to buy it after me versus, we're at thingy highs. We've already trapped a lot of traders here. There's an underlying catalyst that everyone's watching at the moment. There's a lot of fuels to the fire. All of a sudden that becomes a bit more interesting. So maybe you do take the break, maybe pre-position first. So you've got these little tools in your toolbox that you can use to be a little bit smarter about trading. And listen, you don't have to be an expert at everything. You can be very, very strict about when you get involved, when you risk your hard-earned capital. It's your choice. The beauty of being a retail trader is you can sit on your hands, and sitting on your hands is almost certainly the right thing to do most of the time. But if you have these set of criteria and filters that you look for and say, if I see this, I'll consider this, and this is how I'll position, and you put more thought into the structure of the trade, then the chance of success, in my opinion, go up massively. On an individual trade basis and on a longer kind of time frame basis. All right, so just a reminder, guys, if you are struggling with discipline, and actually, I think breakouts come into this, if you're constantly chipping away at breakouts or you're trying to develop a new habit, I do have a Google sheet that I had coded up. Coded up, is that the correct answer? Designed. Hundreds of traders, not thousands of traders have access to this now. Give it away, so absolutely free of charge. You're welcome to use this. If you go to tradersmastermind.com, top right, you can click on a discipline tracker. You'll see this page, enter your email address, and that helps you. So if you're kind of saying, right, I trade breakouts, I need to look for the higher time frame, I need to look for the catalyst, the market's engine, who cares? If you're constantly checking this type of stuff, then at the very, very least, it's going to help you build the discipline muscle and build this continued process that you're just trying to stick to time and time again. And that's it. That's what I've got for you, ladies and gents, today. So, always runs on more than I expect because we're always talking about stuff that I think is super interesting. And actually, if you've got any questions, stick them in the Q&A, guys, or we'll call it an evening there. It's well worth looking at China. Where's she gone? Where's the chart gone? It's well worth looking at China. Like I say, even if you don't trade it, so much going on. Read the news, spend some time. So many different things that are causing this to move. It's super interesting. Retail traders have been piling in this. The brokers have been open at 24 hours opening accounts. They've all piled in at highs. There's stories of traders buying at highs, selling at lows. Institutions aren't so keen on the markets. The government's now adding catalysts. You see this price action. Really, really, really good story for price action traders. All right, I think that is it, ladies and gents, for this evening. We have another webinar coming up next week. Appreciate your attention as always. Take care. Bye-bye.